Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 16th of February. I'm Daniel Lam, your host for the podcast. This will be the only Cut to the Chase podcast for this week, as we have the Lunar New Year holidays. The podcast will resume on Monday, the 23rd of February. So the majority of the fourth quarter US earnings season is over. The major theme is the higher than anticipated guidance of capex spending from the hyperscalers. This has led to investors' doubts about how much return this can generate. Are these companies overpaying to build growth? So first of all, we'd like to look at the beneficiaries in the different areas in technology. We're expecting a 60% increase in data center capex spending in 2026, the third consecutive year of over 45% growth. The AI infrastructure companies related to data center are likely to continue to do well, and themes such as semiconductors have more upside to expectations than the hyperscalers themselves. Now, on to the hyperscalers. Yes, there are rising risks. Now, we expect cash flow from operations from hyperscalers to grow at a 15% to 20% pace from 2026 to 2028, but free cash flow should be dropping by about 80% in 2026. Hence, it is imperative for investors to be focusing upon the quality technology companies that can self-finance the investment in AI capex as much as they can from their own free cash flow, and those that can generate the best growth path from the capex boost. Ultimately, the key to watch out for is monetization. Now, AI monetization will need to ensure supply does not catch up, as this remains the biggest risk to the AI build-out. An excess supply scenario opens risk to the greater fixed cost structure of the hyperscalers. If enterprise productivity gains and revenue from AI services do not materialize, the current investment cycle could face a sharp downturn. In addition, the shift to a physical AI world will be imperative to sustain this level of spending. If AI opportunities are properly monetized, we could see multiples expand, but if it takes longer than expected, we will expect a compression of multiples on fears that we are getting near to the peak of the cycle. But all in all, we believe there are opportunities ahead due to the current dislocations. For example, in the areas where hyperscalers invest in, such as semiconductors and AI infrastructure. But the volatility in the markets, caused by fears of AI disruption, is likely to be clouding the broader markets over the near term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.